Trying to time the market can feel like gambling. But what if there was a smarter, more consistent way to invest? That's where dollar cost averaging comes in. It's a simple strategy that helps you invest over time, reduce risk, and take the emotion out of the process. In this video, we'll break down exactly how dollar cost averaging works, why it can lead to stronger long-term gains, and how you can start using it, even with a small budget. Let's make your money work smarter, not harder. Today we will talk about how to use dollar cost averaging for maximum gains. So before we start, make sure to hit the like button and subscribe to my channel. How dollar cost averaging works. Dollar cost averaging, DCA, is an investment strategy where an investor divides the total amount to be invested across periodic purchases of a target asset, regardless of its price. This means buying a fixed dollar amount of an asset, like a stock, ETF, or cryptocurrency, on a regular schedule, weekly, bi-weekly, or monthly. The primary objective of DCA is to reduce the impact of volatility on the overall purchase. Instead of investing a lump sum and potentially catching the market at a high point, DCA spreads the investment over time, allowing the investor to purchase more shares when prices are low and fewer shares when prices are high. This method doesn't guarantee profit or prevent loss, but it helps remove the emotional aspect of investing. For investors who are risk-averse or uncertain about market timing, DCA offers a disciplined, structured way to invest without trying to predict market highs and lows. Advantages over lump sum investing. One of the most significant advantages of DCA over lump sum investing is its ability to mitigate timing risk. Markets fluctuate daily, and trying to guess the best time to invest a large sum often leads to suboptimal decisions, especially for novice investors. With DCA, investors gradually enter the market, which smooths out the average purchase price over time. This strategy is especially beneficial during periods of high volatility or bearish trends, when prices decline and investors can accumulate more shares at lower costs. DCA also encourages consistent investing, promoting better financial habits and reducing the emotional roller coaster that often leads to panic selling. Another notable benefit is that it allows investors to align their investment contributions with their income streams, such as setting up automatic deposits after each paycheck. This makes DCA ideal for long-term goals like retirement, as it promotes compounding over time while reducing the pressure of market speculation. Building a DCA investment plan. Creating a successful DCA plan involves a few key steps: selecting your investment vehicle, determining your investment interval, and setting a consistent contribution amount. First, choose a well-diversified asset. This could be a low-cost index fund, ETF, or even cryptocurrency for risk-tolerant investors. Next, decide how often you'll invest. Common intervals include weekly, bi-weekly, or monthly contributions. Consistency is crucial, so align this with your cash flow. Then determine how much you will invest each time. Ideally, this amount should be sustainable over a long period and not cause financial strain. Automating the process through your brokerage or investment platform ensures discipline and removes emotional bias from the process. Best assets for DCA strategy. Dollar cost averaging works best with long-term, relatively stable assets. Broad-based index funds like the S&P 500, via ETFs such as SPY or BOO, are popular choices because they represent a diversified mix of companies, reducing risk and offering consistent growth potential. DCA is also effective when applied to mutual funds, retirement accounts like IRAs or 401(k), and even dividend-paying stocks. For more adventurous investors, it can be used with volatile assets such as cryptocurrencies, though this comes with increased risk and requires a stronger stomach for short-term losses. The key is to focus on investments with a strong track record of long-term appreciation. Avoid applying DCA to highly speculative or trending stocks that lack fundamentals, as these could depreciate over time regardless of purchase intervals. When to start dollar cost averaging? The best time to start dollar cost averaging is now, or as soon as you can commit to a consistent plan. Markets are inherently unpredictable, and trying to wait for a perfect time often leads to prolonged inaction and missed opportunities. DCA is particularly useful for beginners who may feel overwhelmed by market volatility and don't have the expertise to time entries. It's also a good choice during market downturns when fear is high and lump sum investing feels risky. However, DCA can be equally effective during bull markets, as it ensures you're participating in market growth gradually. Timing the market is more critical than timing the market, and DCA emphasizes this principle by encouraging regular contributions regardless of conditions. Maximizing returns with discipline. To extract the most value from DCA, discipline is key. Investors often fall into the trap of halting contributions during market dips or chasing hot investments, which undermines the core philosophy of DCA. The true power of this strategy lies in consistently buying, especially during market corrections. That's when shares are on sale, allowing you to accumulate more for the same dollar amount. Avoid checking your portfolio too frequently, as short-term fluctuations can create anxiety and tempt you to deviate from your plan. Use automation tools to remove emotional interference. Also, take advantage of tax-advantaged accounts like Roth IRAs or 400 and ONIC, which can shelter your long-term gains. While DCA is simple in theory, sticking to it during tough times requires strong conviction in your plan and belief in your long-term goals. Over time, disciplined DCA investors can outperform emotional market timers and enjoy steady portfolio growth through both bull and bear markets. Common mistakes to avoid. While DCA is straightforward, there are several pitfalls to avoid. First, investing in poor quality or speculative assets can negate the benefits of DCA, so always do thorough research and stick to fundamentally strong investments. Another mistake is stopping contributions during a market downturn. This is when DCA works best by acquiring more units at discounted prices. It's also common for investors to adjust their DCA plans too frequently. Rebalancing or tweaking strategies constantly introduces risk and defeats the purpose of automation and consistency. Avoid setting contribution amounts that strain your budget, as this leads to missed payments or complete abandonment of the strategy. Lastly, some expect quick returns, but DCA is a long-term approach. It rewards patience. Is DCA right for you? Dollar cost averaging isn't a one-size-fits-all solution, but it fits well for many types of investors, especially those just starting or those prone to emotional decision-making. If you're uncomfortable with lump sum investing or market volatility, DCA provides a measured, less stressful approach to wealth building. It's also perfect for individuals with regular income who want to invest part of their paycheck consistently. However, for investors with a high risk tolerance, strong market knowledge, and large amounts to invest immediately during bear markets, lump sum investing might offer better returns. DCA does reduce the impact of market swings, but it may underperform compared to lump sum investing in a strongly rising market. Ultimately, your decision should align with your risk profile, investment horizon, and behavioral tendencies. For long-term investors focused on building wealth steadily and sleeping well at night, DCA is a powerful hands-off strategy that promotes discipline, reduces risk, and yields significant benefits over time. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.